Global manufacturing is poised for a rebound after a rough start to 2020. Here's a way to see that on paper. It's a Global Manufacturing Purchasing Managers Index, or PMI for short. The chart tracks expected expansion or contraction in manufacturing activity around the world. The numbers released in July 2020 show a manufacturing sector on the mend. The score of 47.8 suggests the economy is contracting at a slower pace than it was earlier this spring. Economists rely on PMIs to get an early read on where the economy could be headed, but some warn that these numbers can't capture the full picture of this recession and its unique burden on smaller businesses. The first thing to know about PMIs is where the data comes from. The numbers on this chart come from a survey of more than 12,000 purchasing managers around the world.
Purchasing manager is the person in an organization that's responsible for getting in all of the things that the company needs to make what it sells. They kind of have a view on how much hiring is going on and all the services that they might buy in from other companies.
These purchasing managers answer questions about things like changes in production, new orders, and change in prices over the previous month. The managers report whether these numbers were higher, the same, or lower. Higher receives a 1, the same receives a 0.5, and lower receives a 0. The answers are then added up, weighed, and averaged into a score, and the scores are plotted into a chart like this one, where the 50 line marks the middle between growth and contraction. One benefit of PMIs during periods of rapid economic change like the one we're in now is that they're able to come up with numbers faster than many government measures.
When you're trying to measure something as complex as an economy, you've got a trade-off, and the trade-off is between speed and accuracy or comprehensiveness. If you want to know accurately how quickly the economy is growing through official figures, you have to wait a few months. With the PMIs, you're getting it more or less as it happens.
That timeliness has helped PMIs give economists a first look at economic downturns. At least they did when the economy was behaving normally. Consider what happened in 2008 during the financial crisis that sparked the Great Recession. That year, PMIs like the Flash Eurozone Index crossed the 50 line in November, an early warning of a coming economic contraction. But official GDP data didn't pick up on what was happening until about 3 months later, and when it did, it matched the trend captured by the PMI. This episode solidified the reputation of PMIs as timely and credible tools. So much so that central banks around the world now use the indicator to inform monetary policies like changes in interest rates. But the economic contraction that began in 2020 may reveal a blind spot in PMI surveys. They can't fully account for the smallest businesses like gig workers or freelancers. That's because larger firms are more likely to respond to the surveys.
One thing that I think it's fair to say they miss out on is the very, very small businesses, the mom and pop stores, the restaurants, the kinds of businesses that are probably most affected by the kind of lockdown that we've seen. One of the issues I think that surveys like this have is that they are time consuming. So I think the information requirement may be a bit tough for very small businesses to be able to handle.
Doing this reporting takes additional labor that some small businesses just can't supply. This spring, companies with fewer than 500 employees lost about 18.4% of the pre-crisis workforce, where bigger firms lost 16.6%, according to ADP.
So you have to remember the limitations that the PMI has. What it is useful for figuring out is broadly how strong or weak the economy is growing. But it's not going to tell you, which bits are growing and which bits are contracting.
Another limitation of a global PMI is that it's a composite. You have to look at breakdowns to spot regional differences. For example, much of the recent upturn can be attributed to recent activity in China. The country is reopening for business, as others in the West are still working to contain the virus.
The Global Manufacturing Index is very heavily influenced by China, which is the largest manufacturer on the planet. Now, the key thing about China is obviously that it locked down earlier because the pandemic hit earlier. So what it is a sort of mix of China recovering and everyone else going through the contraction that China went through in January, February and March. So in a way, it's sort of not telling you about the worst of this. So in this period, particularly in the lockdown period, data doesn't mean what it usually does. It's not as solid.
Still, as the recovery continues, investors and economists will have their eye on the 50 line.